On this week's Emily Now episode, I'll be talking about foreclosures, home builders, I'll be talking about the hot Canadian real estate market, and I'll let you know how banks know how much you can afford when you're looking to borrow a mortgage or a loan. Stay tuned. My name is Dylan Gallagher, founder of mlenow.ca. I've been a finance guy for the past 18 years, helping individuals and businesses access the money that they need, typically in the form of a mortgage or a loan. Each week, we put together this Emily Now episode to educate you about things involved in borrowing money. Our thought is that if you're well informed, that you can make better decisions, and as a result of making better decisions, hopefully you've got some extra money to save for the future, invest in new opportunities, or maybe, who knows, give it back to the local community around you. I'd encourage you to visit mlenow.ca if you are looking for a mortgage or a loan. It's a disruptive online platform that's helping connect borrowers and banks together. You can follow us on Twitter at Emily Now Canada. You can like us on Facebook. We would hope you'd subscribe to our YouTube channel. And of course, you can follow us on Google Plus as well. At the beginning of each episode, we start with a question. And this week's question is, what is foreclosure? Well, I'm not going to get into the legal definition of it because I'm not a lawyer, firstly, but there's also quite a legal process that's involved. But from a high level, many people don't know what foreclosure is or have some misconceptions about it. And so we thought we would try to clear that up. So first of all, foreclosure and bankruptcy, they're not the same thing. Bankruptcy usually has more to do with your unsecured debt. So when you can't pay your credit card, or you can't pay your Home Depot card, or you have other debts that you're just having a hard time keeping up with. Typically, you would go down the road of bankruptcy in that case. Foreclosure, though, has to do with an asset. And the act of foreclosure really is what happens when you cannot pay a bank or lender what they're owed. The bank then undertakes a legal action to recover the amount that is owed to them under the mortgage that you would have granted to them. Foreclosure really has to do with the court taking away the borrower's right to do something with a property. So a bank or lender will ask a judge to get involved in taking the rights away from you, the homeowner, and using those rights now to either dispose of the property, sell the property, give the property back to the bank so that they can attempt to sell it or dispose of it to get their money back. So foreclosure is really just the court taking your rights away as it relates to the property. Now, in hearing that might cause some anxiety or cause you to panic, but the reality is foreclosure doesn't happen overnight. No judge wants to be known as the judge that kicked somebody out of their house and now there's a family sitting on the front yard of some neighborhood. So there is quite a court process involved before the day actually comes where your rights on the property have in fact been removed. So the first thing is to not panic, to not ignore what's happening. Definitely get involved with your bank or your lender and try to come to some sort of an arrangement, but you need to make sure you do something because not doing anything certainly won't help your case. It's important to know that banks and lenders do want to get their money back at some point, but a lot of them are going to work with you. We know from recent events like the flooding from last year that banks can defer payments. They can give you a holiday and a payment holiday on your mortgage so that if circumstantially something has happened in your life that you can't make the payments, that you don't have to worry about it. But you've got to make sure that you're actually talking to the bank to exercise on some of these things. For commercial mortgages, the banks, or rather the court, may not be quite as lenient as they might be with someone's home, but the same principles are at work. The bank doesn't really want to go to court, foreclose, own your house, or own your property and try to sell it. They really would like you to do that work and hopefully give you the ability to recapture some of your money back. So So foreclosure is a legal process. It involves taking your rights away as it relates to a property, and then those rights end up sitting with a judge who makes the decision on how that property now is going to be disposed of so that the creditors can be paid. So if you find yourself in this particular situation, make sure that you reach out to a bank or lender and ask them what options you might have. In order for them to give you that answer, they might have to know a little bit more about your circumstances and why you've found yourself in this position. So don't let foreclosure be something that keeps you up at night. It is serious, but it isn't something that's going to happen to you in 24 hours. You're not going to be kicked out of your property or lose your property in a very short amount of time. You are going to be given the opportunity to try and do something with the property before the court does take those rights away. So moving on to our next question. Question number 2 is, how does a bank know what I can afford? This is a great question that we obviously at mlenow.ca, as people are sending us their information and getting us to help them with their mortgage or loan, this is a pretty big conversation piece. How does the bank actually know how much I can afford? Well, there's two things that you should know. First of all, for residential property, so if you're buying a home or investment property, there's sort of one way that a bank will figure that out. If you're looking at a business loan or you're looking at a commercial mortgage, there's sort of a second way that the bank will do it. So there's 2 different calculations they use, but at the end of the day, the banks are looking to do the same thing. What they end up doing is they say, look, if you're looking to buy a residential home or an investment property, we will take a percentage of your income and we will allow you to use that percentage of your income for the mortgage, the associated costs of that property, plus your other debts. And that number tends to be around 42%. So depending on how much money you make, 42% of that is how much the bank will use to calculate how much you can afford for a mortgage. So they'll say, okay, well, if you make $100,000 a year, we will allow you to spend $42,000 a year on your Visa payment, your MasterCard payment, your car lease, and your mortgage and housing costs. And so after they've deducted out your other debts, they take whatever is left and then they determine how much of a mortgage you can afford from that. If you are a business looking for a commercial mortgage or you're looking for a business loan, the bank, the same principles at work, but they calculate it a bit of a different way. What they say is, for every dollar of debt that you want to borrow, so if you want to borrow, $100, or if you want to borrow $100,000, whatever the payment is on that debt, if it's $1,000 or $1,200, we need to see that you have 1.25% more than that. So basically, for every dollar of debt you have, we want to see $1.25 of net income. So gross revenue, how much money did your business make, less all of its expenses means you've got something left over. Whatever is left over has to be 125% more than whatever your annual payments are going to be. So in both cases, really what the bank is trying to do is they're trying to say, look, we want to make sure that we don't take all of your income to make debt payments, because there are still other payments or other expenses rather, that you're going to have to take care of. And so we don't want to see all of your income being used to pay for debt. So there are specific calculations that the bank uses, and based on whatever amount they're using, they end up applying an interest rate to it, which ends up telling you how much you can afford. So the higher the interest rate, the less you can afford. The lower the interest rate, the more that you can afford. But that too has a bit of a threshold. If you're looking for a line of credit, or you're looking for a variable mortgage or variable loan, the bank will not use that interest rate to figure out how much you can afford. So for example, a variable rate mortgage is, let's say it's prime, let's say it's 3%. Well, the bank is going to calculate how much you can afford based on what are called posted rates. So a 5-year rate might be 4.29%. That's what they're going to calculate how much you can afford. They're not going to use the 3% because variable implies that it is variable. It can go up, it can go down, and the bank wants to know that you're going to have sufficient income in the event that interest rates do start rising. And so they're going to calculate out your ability to qualify based on a higher interest rate, even though the actual interest rate you receive will be lower. So here's what you need to know. It isn't a black box when the lender tries to figure out how much you can afford. They really take and there's a lot of other variables that are involved, but they in essence take your income and they will apply some very simple math to it to figure out how much of your income can be used to make debt payments. And those debt payments will be inclusive of not only your loan or mortgage that you're applying for, but the other debts that you or your company might have as well. So go to mlenow.ca, and if you're looking for a mortgage or a loan, all you need to do is punch in the amount. If you're looking for $500,000 for a home, or you're looking for $5 million for a building, go to mlenow.ca, punch those amounts into the main page, and from there you're going to be able to see how much income you're going to have in order to qualify for those amounts. We're going to move now into a topic that seems to be, certainly here in Calgary, it certainly is an issue that everyone is talking about, and that's home builders who are having trouble keeping up with the demand that our city has seen. And land prices continue to increase, and I'll give you some examples to help illustrate the significance of this. But land prices continue to increase. The lack of available land in the city that can be used to put homes on is, of course, pushing up these land prices. And back in, I think the first construction loan I can remember doing after the crash was in 2010, or maybe the fall of 2010. And a builder had come along and had a 50 by 110 or 120 foot lot, which is a normal inner city lot. And I think they bought it for $400,000. And fast forward to today, in that same community, that exact same lot, nothing has changed. That exact same lot is pushing $800,000 or $900,000. So that price has doubled in less than 4 years. And the price of construction hasn't really changed. I mean, wood is the cost of wood is the cost of wood, and drywall is the cost of drywall. I mean, those costs don't really change very much from year to year. Certainly not enough to affect the overall cost of a property. But those land prices are absolutely killing the market right now. And so if you were able to build a home for $500,000 and the land cost you $300,000, it means your overall cost as a builder was $800,000. But today, that same $500,000 home with an $800,000 lot means that property is $1.3 million. Nothing has changed. The house is the same, the finishing is the same, all the materials are the same, but that price of land has really, really made it difficult for the real estate market to not see the big price spikes that it's seeing. So we work with a builder here in the city, and we've funded quite a few deals for them. And they've got about 12 homes under construction right now, so that makes them certainly a smaller builder. But from these 12 homes, they're going to deliver these homes over the next 10 months, and they don't have any lots locked up today for next year. If you extrapolate that out, there's lots of builders in the market right now that don't have any lots for next year and are trying to figure out how they're going to do that. There's kind of a range of home builders in the market. There are, on the one end, custom home builders that might do 1 or 2 homes a year, but really, really high-end homes with really, really big margins in them. And then on the other end of the spectrum, you have what we'd call production builders. So they're building hundreds of homes a year. Not great margins on each individual home, but because they're building so many of them, they end up making up the profitability. So on that spectrum of builders, all of them need a project. All of them need land. All of them need a lot that they can put that home on. And right now we're seeing in Calgary certainly that land it's not available. And if it is available, it's just very, very expensive. So it used to be, so compounded with not only the cost of land is you have the cost of capital that these builders have to pay in order to build the house. So the builder that we work with right now, a few years ago, before the crash, he could have applied for a builder's line with one of the banks. So that basically meant, basically prime plus money, so 4% money or even less than that. They could have maybe 3 homes under construction, 2 completed, and 1 is a show home. And that their cost of capital to build that, to pay for the materials and to pay for the land, would be very, very low. Today, not only do those builder lines not exist, but banks are really not funding construction files anymore. And that's because a lot of them got burned in the last downturn. They ended up over-financing. They weren't really structured very well, so some of these builders ended up building homes and having no equity into them, so the banks were certainly over-leveraged on those properties. So now what's happened, of course, is that they have to go to either mid-market lenders or private lenders, and now their cost of capital is easily 2 or 3 times what it was in history. So with all these housing prices starting to go up, with the lack of land that is pushing up the cost of land, you also now have this cost of capital that builders have to factor in how much their borrowing cost is when they give that home over to a homeowner, and that certainly is affecting prices. So if you're in the market, if you're a builder looking for money, we'd encourage you to jump on at mlenow.ca to see what options you might have. And if you're a homeowner stressing out about the price of real estate and how it's going up and so forth, maybe you just learned a few things that you didn't know before, that the cost of land has really gone up tremendously. And not only the cost of land, but also the cost of money that many home builders now have to pay in order to put that home together for you to live in. So I don't think anything's going to change in the short term. Banks don't, they're not really lining up to lend money to home builders. And if you're looking to get into the market, you should probably get in sooner rather than later. But anyway, there's a real life example of a home builder that is one of thousands in our marketplace that's trying to figure out how to deliver homes to people coming to the city, but they're now faced with increasing land prices. They're faced with the increase to the cost of their capital, which means that the average homeowner now is paying more for that house because of those things. There was an article that prompted this that I saw this week that said Sotherby's is now offering private jet and helicopter rides for international clients who are looking to purchase real estate. So the idea being, I think, that a high-end homeowner, or rather a high-end client who's looking to buy a luxury home, can come into Calgary, get picked up from the airport, and flown around in a helicopter to any of these very expensive properties that they might be interested in purchasing. And if you go to the National Post or the Globe and Mail, you can't help but flip through the real estate section and see that 2 things, Toronto and Vancouver, get mentioned all the time because they're continuing to experience very, very strong markets. And condominiums now are back in the news. I saw a little note in one of the articles that said banks are now closely watching the number of condo projects that are in the marketplace. And so we've got a hot real estate market, we've got free helicopter rides, and we've got banks starting to talk about maybe we should be careful about how many condo units we're bringing on. So the first thing I think of course, is, haven't we seen this movie before? I've been doing this for a very long time, since the late 90s, and I remember, 2006 through 2007, or rather 2004 through 2007, that our local market was unbelievable. It was a very busy time. Everyone was doing very well, and I think the rest of Canada was as well. And then the crash came, and what we learned was that it was really the financial institutions that drove a lot of the last crash. So it wasn't necessarily just the real estate market, although lenders clearly were over-leveraged, and homeowners and speculators and investors were all betting on a market that would continue to go up, and of course it doesn't. It does correct itself. So I feel like I've seen this movie before. I feel like I've seen all the hype and all the excitement about how aggressive the market is, how much it's growing, how luxury home sales continue to reach all-time highs that they've never seen before. And what I'm experiencing in our little city, though, is I think that that certainly land costs have gone up. I don't know that construction costs have changed. I know we have new people coming to the city, and there is a lack of available inventory, which obviously does push up the price. But apparently foreign investors too are putting money into Calgary. They're investing in projects, they're building buildings and homes, and I think that's happening in Vancouver, in Toronto, and across the rest of the market. So I guess my question would be, what ends up happening now if the public markets start to slide? If there's a correction in the stock market, or maybe life doesn't really work out over there as it should, what does that end up doing to the Canadian marketplace, given that I don't know how much of the increase in value we've seen has been artificial. In Calgary, I think the land price is artificial, and I think that's because of poor politics on behalf of the city to constrain the type of land that can be made available. But across the country, I mean, I don't know what's really driving Vancouver and Toronto's value, but my question is, what happens if the public markets slide? Does that mean that foreign investors take their money out of Canada? Does that mean that all of a sudden these bidding wars that might be taking place for projects in Vancouver and Toronto start to diminish? So I don't really know. I think I've seen this before. I think we've all seen this before. Many of us have seen this type of market before, and so it probably begs the question, what does that mean for the average homeowner or the average person in Canada? And to me, you know, it's probably the same old thing that it always is. You know, live within your means. Don't borrow more than what you don't think you can repay. And even though the real estate market is hot, there will be a day that comes where it's not hot. Most people are signing 25-year mortgages, so that means they're going to pay 3 or 4 times for their home. And during 25 years, it's virtually certain that the market will go up and that the market will go down. So probably not a great idea to have a short-term view on any kind of real estate decision that you're making, but probably best to have a longer-term view on it. And of course, if you're in the construction business, you want to be very sensitive to the price of land that you're prepared to pay for the projects or the properties that you're building. And you definitely want to be very sensitive to the cost of capital and make sure that you do in fact have the right amount of money. So as always, it pays to be prudent. It pays to know your options. It pays to have an opinion about what you think is happening in the market and to look at your own circumstances and make sure that whether the real estate market is hot and helicopter rides are aplenty, or the real estate market is cold and nothing is happening, that you're going to be able to make your way through whatever changes the market might bring. So have a plan, understand your options in the event that your circumstances do change, and if there's anything that we can do to help, we would encourage you to visit mlenow.ca. You're going to be able to see the banks and lenders in the marketplace. You'll have an opportunity in less than, I don't know, probably less than 3.5 minutes to put some basic information together to see what your options might be. And then of course you can engage with us and we'd be happy to help, or send your information directly to a bank and get them to give you a quote on what they can do for you. We have live chat on the website. We've got real people that work with our clients behind the scenes. So if you need help, we'd love to give it. And thanks for joining us on this Emily Now episode. We'll see you next time.